watching The Open on BNN Bloomberg. As we track the markets this morning, we're joined in the studio by Ryan Bushell, President, Portfolio Manager at Newhaven Asset Management. And Ryan, when it comes to long-term trends, because there's the short-term uncertainty, but there are some long-term realities in terms of our electricity needs. You came to the table with a chart this morning that speaks a little bit to this. Can you walk us through what your thinking is?
Yeah, so the chart I found, and I just was scrolling through this morning and found this chart, and I thought it was a really, I've spoke about this on an ongoing basis, but this really brings it home. So this is the growth in electricity demand in the U.S. only by decade. And you can see, the 50s, about 9% electricity demand growth per year. But you get into the 2000s and the 2010s, we basically had stagnant or very little electricity demand growth for well over 2 decades. And now that's starting to come back. And so again, this is a trend that, and Rebecca, we were just talking about, my colleague was saying this morning, well, if DeepSeek is true and AI is not going to use as much power as we thought, maybe that puts a damper on this. And the thing is that this was started under the last Trump admin, under the first round of tariffs, when you started to bring manufacturing back home. That's not stopping. You still have new use cases for electricity in terms of data centers and all the different things that AI is going to do. That's going to create some electricity demand, and you still have population growth and population migration. So that flipping from below 1% a year, even to 2 or 3% a year, which is more than a double, creates a tremendous amount of demand for utilities to upgrade their networks, for natural gas and other sources of power, nuclear, to bring more power to the table. And we think that that's a trend that stays in place for well over a decade.
Okay, and you gave 3 ideas to our producing team today: Pembina Pipeline, Algonquin Power, and Brookfield Infrastructure. And even though my brain might think electricity and the flow of oil, maybe apples and oranges, it all comes together over the long term, you're saying.
Yeah, and so it's difficult because a lot of our portfolio is trading at all-time highs. So AltaGas, Fortis, Enbridge, TC Energy, a lot of those companies have already seen big runs. So these companies are a little further behind, and that's why I'm recommending them. Pembina on the natural gas side, they're touching a tremendous amount of the natural gas that's produced in Canada, with LNG Canada starting up here in the next year or so, along with some other projects we think will follow in behind. We think that's a very positive case for them over the next decade or more, and it's a well-managed company with a solid dividend yield. Algonquin's been a serial underperformer, but it is now a pure play utility, and it's even perked up year to date. It's up about 15%, so it appears that it's coming off the mat. Still a lot more heavy lifting to be done there, but we still think the assets are good on the underlying company. And then with Brookfield Infrastructure, they just announced a monetization, and that's sort of the private equity side of Brookfield, of buying and selling assets. There's concern that that might slow down in the market to come, and I don't disagree with that. But in the meantime, you're getting a great operator, 6%, almost 6% dividend yield on the partnership units. They trade almost a full percent cheaper in terms of dividend yield than the stock units, which are held by institutional investors. So I think as a Canadian with an RSP or a TFSA, that's a great investment for you at a discount.
So it's really, I can't think of a more exciting time for utilities. Mm-hmm. It's still a heavily regulated industry. And so I always wonder, especially for some of the other ones you mentioned, like if you look at the average target prices, I don't think it's going to surprise you in some cases, there isn't like a chorus of people on the street recommending them right now because they've had big runs. Yep. Does the fact that this is a heavily regulated industry, do you have to be mindful of how that actually allows them to grow year to year? Yeah,
definitely. And that, it's funny, we get excited about them going from sort of 3 to 4% growth stories to 6 to 7% growth stories, right? So we're not talking about tripling the rate of growth in these companies or anything like that. But when you see, what we want is the duration. We want the long tail of cash flows and the long tail of stock performance to sustain our clients' lifestyles for, if we get a client at 65 years old, we're planning for the next 30 plus years for them. So we want that long tail. And so that is what we get excited about, is when that long tail becomes, again, 6% every year for 15 or 20 years versus, a couple of good years and then the stock falls back.
We're almost out of time, but would you be banking on, if they see that growth, is there a reasonable expectation that a good chunk of that becomes income for investors, that they boost their dividends?
I think the dividend growth grows in line with earnings. So again, steady growth in earnings. So again, we're not seeing a big uptick, but it is a slight shift upwards. And again, for us as investors, we would own this anyways because it suits our clients' lifestyles. To see just even a slight uptick in growth on an annualized basis is exciting for us when you start multiplying it out over a number of years.
Okay, Ryan, appreciate the insight as always.
Thanks, John.
Ryan Bushell